Good afternoon, everybody, and welcome to the latest event in our series of professional advisors working lunches. Today, brought to you courtesy of our partner, Baillie Gifford. I'm James Baxter-Derrington with Professional Advisor, and I'll be your host for the next hour. Now, just before we get going with today's session, let me quickly run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we would be most grateful if you could keep them that way. It will ensure there's no background noise so the speakers can be heard more clearly. I should also inform you that this session is being recorded, and we will send you a link of the recording by tomorrow, and do feel free to share this with your colleagues. And as usual, today's working lunch will qualify for 1 hour of CPD, and we'll be sending your proof of attendance along with the link to the recording of the session, which will arrive in your inboxes tomorrow. Our session today is entitled Investing for Positive Change. The weather events of this summer serve us with a stark reminder of the effects of climate change and the increasingly urgent need for change. Equally, the drive for diversity and inclusion in business continues to gain momentum. There's no question that fund managers can have a huge influence over the companies they invest in. The question is, how do they walk the tightrope between driving a positive change agenda and, at the same time, deliver returns for their investors? So, with that backdrop in mind, I am delighted to be joined today by Baillie Gifford's Rosie Rankin, who is a positive change specialist with the Baillie Gifford Positive Change Fund. Over the next hour, I'll be talking to Rosie about the fund's recent performance, Baillie Gifford's approach to long-term thinking, and how investors can utilize a forward-looking, active approach to achieve these two aims, and discuss how the fund reports on progress towards its impact objective. Do feel free to put any and all of your questions to Rosie using the chat function, which you'll find at the bottom of your screen. If you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message, so only I can see it. Now, just before I hand over to Rosie, let me quickly run you through our learning objectives for today. Rosie will explain what positive change means in the context of a listed equity portfolio. She will reveal how to think about a portfolio with dual objectives, and she will explain how to approach reporting of non-financial metrics and impact reporting. So, that's the CII and CPD covered. Now let's hear from Baillie Gifford's Rosie Rankin. Afternoon, Rosie.
Good afternoon. Nice to see you, James, and it's lovely to be with everybody this afternoon, and I'm looking forward to spending the next hour or so with you. Now, to get started, please allow me to share my screen, and we'll be able to so hopefully that is the slide there. James, you can give me a nod if you're great.
I can see that perfectly. So I suppose what might be the simplest place to start is just, what do you mean by positive change?
Yes, thank you, James. Well, I don't know about you or anyone else on the call, but certainly at the moment, watching the news or listening to the news, it can get rather depressing. We have all the environmental challenges that you mentioned, such as climate change, biodiversity loss, water scarcity, combined with some really almost overwhelming social challenges around persistent poverty, cost of living crisis, of course, the ongoing COVID pandemic. And I guess as investment managers, what we want to think about when we're thinking about positive change is, can we invest to provide solutions to any of these big global challenges? And in investing in these solutions, can we also generate attractive investment returns? So to answer your question, James, when we're thinking about positive change, what we're really wanting to think about is the companies who are providing solutions to some of these huge global challenges. Because I think often when we think about responsible investing, people often approach responsible investing with quite an exclusionary mindset. So thinking about their portfolios in terms of what they don't want to invest in, whether that's particular companies or sectors or geographies. And certainly that approach to sustainable or responsible investing can be a good way of aligning your portfolio with your values, mitigating ESG risk. But in terms of really addressing some of the challenges that I've just mentioned, it has its limitations. For example, I don't know what you would exclude from your portfolio if you wish to address persistent poverty, or what you wouldn't invest in if you wanted to improve access to transformative healthcare, for example. So within positive change, the starting point isn't exclusion. Instead, the starting point is very much inclusion and thinking about a small number of exceptional companies whose products are really addressing some of society's challenges. Now, we do that because we think it's an effective way of meeting global challenges, but we also do it because we think that that is a good way of generating attractive investment returns. And that's because our underpinning belief in positive change, that companies that are solving society's challenges will prosper in the long term. Now, why do we think that? Well, first of all, if a company is doing something really useful overall, they should benefit from rising demand for their products and services. If there's real utility to what they're producing, they should naturally have motivated employees, they should benefit from loyal customers and rising demand for their products. So we're looking for those businesses that have real social utility to their products and are well-run businesses that we believe can generate attractive investment returns over the long term. Now, impact investing isn't new. It's been around for decades. It's traditionally been more associated with private equity and infrastructure type investments. But I think impact investing through listed equities has a real place in people's portfolios as well. Not just because listed equities are liquid and accessible, so available to a huge range of investors, but also, most importantly, because listed equities are scalable. And it's undoubted that a huge amount of capital is going to be required to solve the problems the world is facing. The UN, for example, estimates that $5 to $7 trillion per year is going to be required in order to meet the UN Sustainable Development Goals, those 17 sustainable goals that the UN has set for achievement in 2030. So that's a bit of context as to how we're thinking about positive change. But how do we approach that in terms of a portfolio? Well, we've been managing positive change now since the start of January 2017, so around 5.5 years ago. We have two equally important objectives with positive change. First, to outperform the MSCI ACWI over rolling 5-year periods. And secondly, to contribute towards a more sustainable and inclusive world.
It usually just drops off after like 5 to 10
And
minutes.
it's really important
I don't
to
need to
say,
sit on there if it's been run by
somebody's
inflator.
microphones maybe
Or
gone
should I-
off. Yeah, thank you. It's really important to say that for any company that we invest in, they have to meet both objectives. So we wouldn't invest in a company that's contributing towards a more sustainable world, for example, if we couldn't also see its ability to generate attractive investment returns. And when I talk about attractive investment returns, what we're really looking for is to have conviction that a company can double in share price terms on a 5-year view, and for that doubling to be driven by the fundamentals of the business, so earnings and revenue growth. Now, for those of you who know Baillie Gifford, you will know that we love running concentrated portfolios, and positive change is no exception. The stock range is 25 to 50. There are currently 35 names in the portfolio, which is fairly typical. You can expect the portfolio to look very different to the benchmark. So active share is high, typically 95% or above. We're very long-term in our time horizon. So we aim to invest in companies for 5 to 10 years. So turnover is really low, below 20% per annum. And very much growth in our mindset. Now, one of the challenges we have is thinking about how to approach the investment universe. And in order to help focus our research agenda, we have 4 impact themes. So we're looking for companies who can help address challenges in the area of social inclusion and education, environment and resource needs, healthcare and quality of life, and base of the pyramid. I'm often asked what base of the pyramid is, and it is looking for companies whose products and services help those at the very bottom of the global income ladder. So incredibly, there are still around 4 billion people in the world who are on less than $3,000 a year. So within base of the pyramid, we're really looking for companies whose products are helping those who fall into that category.
Fabulous. Thank you so much for that rundown of precisely what positive change and impact means there. I suppose what might be helpful, certainly for me, is that while investment returns as a financial metric, that's relatively straightforward to understand, but this fund has an extra element to it with that social impact, with that positive change impact. How do you assess and report on impact?
Yes, it's a really good question because it's very important to us, it's important to our clients, it's becoming increasingly important to regulators as well, that if you set out to have 2 equally important objectives, it's very important to report on both. Now, perhaps before we kind of dive in a bit into impact reporting, it would be useful to understand actually, how do we analyze and assess impact in the first place? Because that really feeds in then to the fundamentals of your reporting. One big challenge that we have is that we have such different types of companies in the portfolio. For example, I mentioned base of the pyramid. Within that category, we have an Indonesian bank. Within healthcare, we have companies such as Moderna, the innovative biotech company. Within environment and resource needs, we have offshore wind producers. And then in terms of social inclusion and education, we have companies which are promoting financial inclusion, companies that are offering access to education. So how do we compare and contrast very different types of companies having impact in completely different spheres? In order to provide some consistency as to how we think about impact, we have a framework which has 3 factors to it that you see in front of you. And what I thought I'd do today is use a company as an example. So I've chosen the education company Coursera. It's been in the portfolio since March of last year when it IPO'd. And actually, IPOs are something we really like to participate in with positive change. There's something impactful about providing primary capital to these businesses as well. But how do we think about assessing businesses from that positive change aspect? We look at three factors of intent, product impact, and business practices. So for intent, we're really trying to go beyond a company's mission statement. Interestingly, Coursera's is serve the cause being education. Education is all that they offer through their platform. And we're really looking to see the actions that executives and founders and board members have taken to support that intent, whether it's in the case of Coursera offering financial aid to lower income students or tracking their career outcomes, for example. We then look at product impact. And for us, this is the most important part of our impact analysis. We really want to understand the link between what a company produces and the impact that it's having. Now, Coursera provides a range of different educational courses. It has links with universities, so can offer degree courses. It offers very short one-day courses. It offers mass online learning courses as well, and also works with businesses and corporates to provide kind of job appropriate training as well. And what we really want to understand when we're analysing it is how many students are accessing the platform, how many of those students are reporting a benefit, how many students are achieving accreditation. Not only is this really important from assessing positive change, but it also provides a very strong link through to the investment case. Because our investment case is predicated on Coursera increasing revenue and earnings through expanding the range of courses that it offers and increasing its student numbers. And of course, those factors have a really strong link to the impact that Coursera will have. And that's what we're always looking for, is for where investment and impact will go hand in hand with the company. Thirdly, we'll look at business practices. And this is really looking at a company's attitude towards ESG. So how it approaches its environmental responsibilities, how they work with stakeholders, how the company is governed. Interestingly, Coursera is a B Corp, which is an extremely high standard of social and environmental accreditation. It's important to say when we think about business practices that we like to see good business practices from companies. We think that will support their long-term growth over our investment time horizon. But we're not looking for companies with perfect business practices. And this isn't a portfolio of companies with perfect business practices. It's a portfolio of companies with really compelling product impact. Now, hopefully that gives you a bit of background to how we assess impact. James, you asked how we then report on impact. So we produce two very comprehensive reports every year. One is a report called the Impact Report. And this goes into the impact of every single company in the portfolio. And I'll share some of those metrics with you shortly. And the second report is a document called Positive Conversations. Now, that explores some of the business practices of companies in the portfolio. But really importantly, Positive Conversations starts to think about the impact that we can have as shareholders. what difference does it make to companies that Baillie Gifford is on the share register? So Positive Conversations explores the engagement that we've undertaken over the calendar year, and also discloses the proxy voting activity. Now, first of all, I just wanted to share with you some of the metrics that we look at in the impact report. Now, this is a very simplified version that we're looking at here, but I thought it might be useful in illustrating how we think about measuring impact. And again, it's that challenge that I talked about having very different companies doing very different things within the portfolio. But we analyze it using our consistent framework. Now, it's based on the theory of change, and the theory of change is often used when reporting on impact. It looks at the inputs, activities, outputs, outcomes, and impact of any particular company. The one I've chosen to look at here is New Holdings. Actually, again, we participated in their IPO just at the end of last year. It's a digital bank based in Brazil. It's actually now the world's largest digital bank. So when we're reporting on the impact, we look at the inputs, that's in terms of financial and human capital. We look at the activities. As I mentioned, New is a digital bank. We look at the outputs. So how much digital banking does New do? You can see there they've just got over 53 million customers. But what does that mean in terms of outcomes? And one of the statistics we're looking at for a company such as New is actually the financial inclusion that they're driving. Are they facilitating financial inclusion for people who haven't used banking facilities before? And encouragingly, with New, just under 6 million people have taken out their first credit card or bank account through New's digital services. Now, that outcome we're looking at is an annual outcome, but we want to think about how does that lead to a long-term systemic impact? And this is where we map to the UN Sustainable Development Goals. There are 17 goals. Underlying the 17 goals are 169 targets. You can see here that we have linked New Bank to 3 of the Sustainable Development Goals: no poverty, decent work and economic growth, and reduced inequalities. Just below the New case study, you will see the Sustainable Development Goals that the portfolio as a whole links to. So the portfolio as a whole links to 16 of the 17 goals. But of course, that number may change over time and very much reflects the companies that are currently within the portfolio. And finally, in my very long answer to your question, James, what we can do is we can aggregate together different parts of the company's specific impact to have some overall aggregate statistics. Now, in our current report, we have 14 aggregate statistics. I've shared 3 of them in front of you. And so we can say, for example, that across the whole portfolio, the companies have allowed savings of 87 million metric tons of CO2 emissions, for example. Or that companies within the portfolio have provided access to education and training for 597 million learners. Now, there's quite rightly a lot of focus just now from regulators and the market in general on the robustness of impact reporting. In order to help us kind of be as robust as possible, we have appointed a third party to provide limited assurance over the impact report. We use KPMG for that, and they've performed that service for us for the last 4 impact reports that we've written. I'll perhaps pause there because I realise I've just done a lot of talking in my enthusiasm for impact analysis and reporting. Well, I'll stop there.
No, absolutely. I appreciate it massively. It's a very helpful answer to quite a nebulous question, really. So it's always good to see how that can be quantified beyond just those conversations. I just want to remind people quickly that, as well as all of the questions that I'm curious about, do feel free to pop in the chat any of your questions for Rosie, and we'll make sure to get to those throughout the presentation and also during the Q&A at the end. But I'm going to jump in with one more for now. And you mentioned conversations there. So what about engagement? What role does that play within impact and the portfolio?
Yes, really happy to cover that, James, because as I mentioned, we publish positive conversations every year. And this has within it, as I mentioned, a summary of some of the business practices of companies in the portfolio. In particular, a lot of the environmental metrics clients are particularly focused on in terms of thinking about carbon footprint, for example, of the portfolio and our net zero commitments. And then importantly, as you said, it summarises all the engagements that we've undertaken, because this is really where we can start providing some value to the companies in which we invest. We want to be supportive long-term shareholders. We want to really understand the intent of the businesses that we invest in, and where we can support them in their long-term strategy, where we can challenge them on areas that we think could be improved. We'll absolutely do so, and it's very much with that kind of supportive mindset. And it's really important for us to have these conversations, and I would stress in the vast majority of cases they are conversations. We like to meet with senior executives and with boards, as well as with a range of other staff at the companies in which we invest. And in a typical year, we will meet with the vast majority of portfolio companies. You can see there over the course of last calendar year, we met with 31 out of 35 holdings.
Beautiful. And I think, we spent a long time there discussing this secondary factor within the portfolio, perhaps not secondary in terms of how it ranks, but secondary in terms of not that long-term investment performance that we're used to discussing solely when we talk about funds. But I suppose it might be worth raising that now. And obviously investment performance is a hugely important part of why people would want to invest with yourselves. And long-term returns across the fund are strong, but the short-term performance is perhaps a little bit weaker at the moment. I suppose, could you talk to that and raise maybe how the fund itself is positioned?
Yes, really happy to do that. As you said, long-term performance has been strong, but short-term performance has been very weak. You can see there from the statistics in front of you that over the course of the last 12 months, the fund is down around 30%. Although if you look since inception, it's returned about 19% per annum, which is well ahead of index. So perhaps I could almost divide my comments into those two time periods. Firstly, taking short-term performance. And I suppose my overall observation, and it will come to no surprise to anyone on the call, is just the extent of the volatility that we've seen, particularly over the last 6-7 months. Lots of factors contributing to that, including, of course, the ongoing pandemic, Russia's invasion of Ukraine, rising interest rates, rising inflation, and none of that will be news to anyone on this call. And what we've seen as a result of that is we've seen a real dislocation between the operational progress of many of the companies in the portfolio and their share price. the types of companies that we invest in, many of them are quite early stage companies. In terms of looking at their growth, it's a long time out into the future, and those types of companies tend to be particularly impacted by negative sentiment in terms of periods of rising interest rates. But we continue to see really strong progress from these companies, whether it's Dexcom with introduction of continuous glucose monitoring systems for diabetics, again, really strongly expanding its patient population. Moderna will continuing to produce the COVID-19 vaccine, but with a really strong pipeline of other vaccines and therapeutics around the corner. So continuing to see really strong operational progress, but market share price weakness has come back or so in the last month, but that's probably too short a time period to meaningfully comment on. But looking out over our investment horizon, and Positive Change does have that 5-year investment horizon, I think what we're most struck by is that our underlying thesis that investment and impact will go hand in hand has been borne out. And looking at those companies that have contributed most strongly to performance, you can see that we have some companies such as Tesla, which of course has seen really strong share price performance as they've demonstrated the ability to manufacture electric vehicles at scale. Dexcom, which I mentioned, which has rapidly expanded its patient population that it's treating with its continuous glucose monitoring systems. ASML, which is really driving change through its innovative lithography equipment, which allows ever increasing speed and energy efficiency and improvements in performance of semiconductors. But I won't pretend for a moment that we have got everything right. You can see there in grey on the slide in front of you the companies that have detracted performance. So we have slides there, companies there such as Cogna Education, the Brazilian education company that was early holding in Positive Change, where our thesis didn't come to fruition. Companies such as Beyond Meat, which has had a really tough time over the last few years, Eugelina or Peloton, which would be a familiar name to many. But for the companies that have detracted and we still hold, we will continue to hold companies through short-term periods of operational or share price weakness, providing we think that our long-term thesis of investment and impact is still intact. Hopefully that gives a flavour of how we're thinking about performance. Now, what have we done in the portfolio as a result of all the share price weakness that we've seen? I would point to really 4 things that we've done. Firstly, we have stayed absolutely true to our philosophy and process. So we continue to think with our long-term time horizon. We continue to focus equally on our 2 objectives, and there has been no change at all to our philosophy and process over the last 12 months. Secondly, we have been looking at the resiliency of all the companies in the portfolio. Now, we've been doing this work in conjunction with our investment risk teams, so looking at companies and kind of resiliency to an environment of rising inflation, to rising interest rates, looking at, for example, whether companies have the pricing power to enable them to pass on rising input costs. We've also been out speaking to the companies. So Lee, one of the investment managers, spent a few months in the US, visiting many of the US domiciled companies in the portfolio. Kate Fox, another of the investment managers, has recently returned from a trip to Scandinavia, again visiting some of our companies there. And it's really trying to understand how companies are staying true to their long-term strategy in a period of economic volatility. Thirdly, we've actually done very little trading in the portfolio. Now, that's very in keeping with our long-term time horizon, but it's also very in keeping with the fact that really we've seen the whole portfolio being impacted by the volatility that we've seen. And so actually the shape of the portfolio, the overall position sizes haven't actually changed very much over the last 6 months. And whilst we've taken advantage of some areas of weakness to top up companies such as Mercado Libre or Anylum, really the level of trading within the portfolio over the last 6 months has been very low. Which brings me to my fourth point about where have we spent our time? Well, obviously we've been looking at the resilience of the current portfolio, but most importantly, we have continued our search for new ideas for the portfolio. In terms of thinking of our pipeline of ideas and the challenges the world faces, there are lots of areas which I can come on to that we're exploring in terms of new ideas for the portfolio. But I'll perhaps pause there in case there are any immediate questions on performance or position.
So there are a few wonderful questions coming in, a couple relating to specific companies and some on the top level of the fund. I think I might just run with one final question and then we'll dive into those, and I hope that no one shouts at me for doing so. But I'm just curious, in terms of where you're headed now. Obviously you've explained where we've come from, how we've got there and what's happening, but just generally, what's the team working on now?
Yes, that's probably a nice way to round it off, James, and then we can dive into everybody's questions. So we've got a really rich pipeline of ideas for the portfolio. We continue, for example, to do a lot of work on sustainable agriculture. As part of his trip to the US, for example, Lee was visiting various companies that are innovating in different ways in agriculture. For example, vertical farms, you can see one there in the plus sign in front of you. So farms, indoor farms that grow crops vertically, that can be positioned very near to urban centres. Cultured meats, so lab-grown meats, and also insect protein, an interesting area to start to explore. We continue to do work on sustainable transport and thinking broadly about the energy transition and what companies will benefit from our shift over the coming decades from fossil fuels to renewable energies, and what companies are needed to facilitate that. We also continue to do a lot of work on base of the pyramid. You may have noticed when I shared the portfolio slide there that we only have 2 companies within base of the pyramid currently. We would love to find more companies that are really helping to improve the lives of the very poorest in the world. So doing quite a lot of work in looking at companies within India and Africa, as well as Latin America. One of the senior impact analysts is, along with one of the investment managers, is heading out to Latin America next month, for example, to continue our search there. And then lots of ideas in terms of healthcare. So working closely with many colleagues across Baillie Gifford in terms of understanding the really kind of fundamental changes that we're seeing in our understanding of biology, and the companies that are starting to develop really innovative treatments and solutions based on that. James, hopefully that gives you a good flavour before we...
That absolutely does, and if I could click buttons better, I'd have been on the screen a moment earlier than that. So just before we dive into the Q&A, there's some fabulous questions there, and please do keep adding them, and we'll make sure to get through as many as we can. Just one tiny note of housekeeping. There are 3 attendees who we are currently unable to correlate to their registrations, and in order to get that CPD certification, we will need to be able to do that. So you should receive a message at the bottom of your screen in the chat function from Joe Gilby with Professional Advisor. So if you could just respond to that message with your full name, and we'll make sure that accreditation comes properly for you. But turning to the questions, let's start with one of the higher level questions, and then we can dive into more of those stock specific ones. There's one question here regarding ESG rating. So how is it that a positive change fund can have only 3 out of 5 stars on an ISS ESG rating, whereas a standard equity fund such as Fundsmith has 4 stars with no claims of sustainability or positive impact?
Yeah, that's a great question. One that comes up quite frequently. And I guess it's looking at those differences in methodologies between what the ESG ratings providers are looking for and what we're looking for within positive change. So typically with the ESG ratings providers, they have the, unenviable task, I have to say, of rating thousands and thousands of companies. And they tend to do so by focusing on ESG risks. So we'll mark down companies based on perceived ESG risks. That's typically around business practices rather than products. And to make their assessments, it's very much based on company level disclosure. Now, when we're looking to invest for positive change, what we're really looking for, while we consider ESG risks, is much more that product impact going forward over the future. We invest in a lot of early stage companies. Typically, but not always, they will score poorly from ESG ratings providers. And it's not because they will be doing anything wrong per se, it's because their disclosure levels are much poorer. They are simply earlier stage companies who don't have that level of disclosure. Don't get me wrong, there will be companies in the portfolio which score more poorly on ESG kind of practices, but we are really looking for the companies that are driving change through their products. So we're not focused on disclosure, we're not focused on ESG risks. So I guess if you're looking at ESG ratings providers, they're looking at really quite different things than we're looking for within positive change.
Perfect. And then turning to a couple of stocks, and you mentioned there the various ESG risks that some of these have. One of the investment themes, one of the impact themes rather, you mentioned was this base of the pyramid notion. And there's one question here regarding Tesla. Now, of course, not all of these stocks will fit all of those themes, but is there any way in which that relates? So, for example, it is a very high-end product that Tesla produces, benefiting what you might refer to as the top end of that pyramid. Is there an investment case for how it fits base of the pyramid, or how does it justify its place in the fund, with that being one of the themes?
Yes, yeah, absolutely. So yes, within our 4 impact themes, Tesla is within environment and resource needs. As you said, most of their products are very much aimed at the kind of mid to high end of the market. So they're not targeting their products at all at the base of the pyramid. But I think where we like to see Tesla's influence is clearly they're helping to drive adoption of electric vehicles. And I think we've been really excited in the past about Tesla's ability to be an agent of change. If you look over the last 5 to 10 years, arguably Tesla has been a catalyst really to really mobilize the entire industry to think about expediting their plans to move more towards electric vehicles. And whilst that doesn't directly benefit base of the pyramid at all, it does indirectly benefit us all if it's helping to lower overall global CO2 emissions. So yeah, that's how we think about it. So yes, wouldn't pretend for a moment that it's directly benefiting base of the pyramid, but overall, if it's an agent for change for us adopting electrification of transport, I think it's a positive.
And just turning to another stock, one that you mentioned and used as the example actually for the impact assessment, New Holdings, the digital bank in Latin America. Do you have any concerns that this digital bank is perhaps trying to lend to people who have never previously had that bank account? And is this in any way, to your mind, similar to the lending mortgage monies to those first-time house buyers that, you know, was a very key impact and cause of the financial crisis in 2008?
Yeah, I think it's a really important question, and one when we're looking at any company that we're investing in for financial inclusion, that we're asking ourselves in terms of their lending practices, say who they're lending to, the types of interest rates that they're charging. So certainly that was part of our assessment of New Holdings. It's interesting, one of the reasons that New have been able to acquire so many customers in such a short period of time has been that they were disrupting the Brazilian banking market, which has traditionally been dominated by a handful of very large incumbent banks who were really only interested in the kind of wealthier end of Brazilian customers, and had a reputation for high banking charges and relatively poor service levels. So with New coming in, they charge much lower fees. Their banking accounts are free, and they offer much lower credit limits, so you can take out much smaller loans and credit cards. So their practices appear to be responsible. Interestingly, I mentioned that one of our impact analysts is going out to Latin America, so he'll be visiting Brazil and speaking to New yourselves. So we continue to kind of monitor and check our impact hypothesis, because it is really important to us, and what we don't want to make that simplification that lending overall good. You really have to kind of drill down into that a bit more to understand what lending practices are associated with that, because whoever asked that question is absolutely right. What you wouldn't want to do is kind of facilitate a level of unsustainable indebtedness amongst people. That would be the opposite of positive change, really.
And then turning away from the stock specific questions and on a higher level even than the individual fund, I think a question that perhaps we had expected to come during the course of today, simply, when can we expect Baillie Gifford to bring its current underperforming funds back on track? As we all know, that the performance has been perhaps a little weaker than it's been in past years.
Yeah, I think it's really kind to say a little. I think it's probably been a lot weaker over certainly the last 6 to 12 months. I can't speak to the details of any of the other strategies, but what I can say that overall is very much that Baillie Gifford remains absolutely focused on what we do and what we set out to do, and that's being active managers, it's being growth managers, it's being long term. Absolutely appreciate that it's really tough for our clients just now. I can say from a personal perspective, I've got a large amount of my own kind of pensions in Baillie Gifford funds, so I know that feeling when you kind of look at your kind of platform app and see the decline in value. So I can completely appreciate that is tough, but I think the assurance that I've got and can see every day is that we're absolutely still focused on those companies who we think are very well positioned for growth over the long term. And it's because we can see that fundamentally strong operational performance, which, due to our growth philosophy, we absolutely believe will lead to strong share price appreciation over our investment time horizon. So yeah, absolutely really focus on the job in hand, but I can't give any time period for when we will see that kind of rebound that we'd all like to see. As I said, July was strong, but that's only one extremely short time period, especially in the context of a 5 to 10 year investment horizon.
Absolutely. I'm going to dive in with a question now, if people don't mind, but please do continue to add those questions to the chat. We do still have some time, so if there's anything you're confused about or keen to ask, please do so. From my point of view, Rosie, you mentioned early on in the presentation that you begin the process of the portfolio and the general theory behind it with inclusion over exclusion. But is there any value to excluding certain names based on whether or not they offer that positive change, or is it worthwhile always being open to everything and analysing them on their individual basis?
So certainly with our mindset, we want to maintain that openness. I mean, there's some companies that sort of naturally self-exclude you. For example, if we were looking at a tobacco company, that would be a very short look indeed. But I think what we want to be open to, and the reason that we don't kind of start off with that exclusionary mindset, is that you want to be open to the companies that are in transition. And I guess a really good example from the portfolio would be Ørsted, which is now the world's largest producer of offshore wind energy. But at the time that we invested in it, it was still called Dong Energy, so Danish oil and natural gas. Its roots are very much in fossil fuels. It still has a proportion of its revenues, and less than 10%, derived from coal power generation. But that's exactly the type of company that we want to support, a company in transition, a company that's made a commitment to be fully to have its revenues fully from renewable power within the next few years. And we want to be supportive long-term shareholders in that type of company. So I guess that's just one example of why we don't have a kind of exclusionary mindset. We want to be open to all opportunities.
And then just turning to the UN Sustainable Development Goals, you mentioned that 16 of the 17 were currently being targeted by the fund and had some investment that would positively impact those and address the issues. Just a question on the final one there, the peace, justice and strong institutions. Is there anything on the horizon that might be able to address that, or is it a particularly difficult goal for investors to tackle?
It's the latter. It's a particularly difficult goal for investors to address. And I guess taking a step back, these 17 goals weren't created for the investment industry at all. They were created by the UN as universal goals, particularly for countries and governments to aim for. It's been really interesting that the Sustainable Development Goal framework is one which the investment industry seems to have kind of gravitated towards as being a useful framework, but it wasn't designed for our industry at all. And certainly that one of peace, justice and strong institutions is something that's much easier for countries to think about rather than listed companies.
Certainly. We still have time for more questions. I'm just going to ask one more to give people a chance to put those in if wanted, but if not, then we're absolutely fine to wrap up slightly early there. I suppose with investors coming to their financial advisors and raising these kinds of questions about sustainability or positive change or simply investment return, how best should advisors and investors consider the positive change fund within a wider portfolio?
Oh, good question. And I guess it's an ever expanding universe of funds that everyone on this call will have to navigate with clients, and lots of confusing terminology in terms of impact and sustainable and responsible. And I don't need to tell anyone on this call, but it will be very client specific in terms of what their risk appetite is, and also what their goals are in terms of the impact that they want their capital to have. Are they just wanting their capital to avoid certain sectors or industries, or are they really wanting to see their capital addressing challenges? And that will be a very kind of specific thing to individuals. I would say that one thing I am encouraged by is that whilst it can make for quite a confusing array of options, I'm really encouraged by the choice that investors now have within the sustainable fund market, because you want there to be lots of different asset classes. You want there to be equities and private equity and fixed income in terms of responsible investment, and you want these assets to be kind of high quality fund options, because ultimately you do need that kind of whole menu of funds in order to put together solutions. But I kind of admire everyone who has to do that, because luckily I can just focus on positive change, but you can have to put something together for clients.
Fantastic. So we've just had one more question drop in here, which is a very timely one. What impact do you see of the ever-rising cost of living during the autumn and winter having on your portfolio and the market in general? Is this an especially difficult time, perhaps unprecedented, both for individuals and investors in the market?
Yes, and I mean, it's definitely something we're considering, and when we think about it, and we're thinking about it again very much from that company specific level within the portfolio, because you can think about it in terms of, well, what companies are going to see demand for their products impacted by people's cost of living rising, the prospect of people having less disposable income. How will that, and I guess it ties in as well to that work that I mentioned that we've done on the pricing power of industries, as in which items will customers continue to buy. Looking across the portfolio as a whole, there are very few companies that in the portfolio that are more kind of discretionary spend items. Many of the companies in the portfolio are offering kind of essential items that people will continue to invest in. So, for example, whether it's continuous glucose monitoring systems or their access to bank accounts or whatever, we'll see that continuing. You know, we are more vigilant on companies such as Peloton, for example, that perhaps is more of a kind of discretionary spend. And then you just want to see companies as well behaving responsibly during this period and being cognizant of the rising costs of living. And thirdly, we look at companies that perhaps will allow people to address their cost of living concerns. It's interesting with Coursera, which I mentioned, the educational platform. They're seeing many of the students on their platform being people who are either wanting to reskill to get better paid employment, or are re-entering the workplace after having a period of time off. And again, companies like that, which are perhaps helping people to improve their employment and income generating opportunities, are pleasing to see. But it's a really good question, and as we look across the portfolio, it will affect companies in different ways. But yeah, great question.
Fantastic. Well, I think we're coming right up towards the end of our time there, so that will be our last question. And thank you so much, Rosie, for what was a really fascinating presentation, and also for all of your insight into what was quite a difficult Q&A session sometimes. There are quite a lot of very incisive questions and some tough ones from people in there.
Great.
So just before we wrap up, some bits of housekeeping and other notes. We'll have one quick look over the learning objectives once again. So throughout the course of the past hour, Rosie has very kindly explained what positive change means in the context of a listed equity portfolio, revealed how to think about a portfolio with dual objectives, and explained to us how to approach the reporting of non-financial metrics and impact reporting. So that for us is all we have time for today. And thank you all for your questions. And once again, to Rosie for joining me this lunchtime. Just before we close up, I will assure you all that your CPD will be delivered tomorrow. And that is it for today's session. We are taking a break for the next 4 weeks, but we will be back again with a very busy program in September. So let me leave you with a teaser of what's to come. On the 6th, 7th and 8th of September, we launch our inaugural Scotland and Northern Ireland Investment Roadshow, where we'll be visiting Belfast, Edinburgh and Glasgow. So do come along to hear presentations from Albemarle Street Partners, HSBC Life, Orbis, Pictet, Simply Biz and Vanguard. Our keynote speaker for the roadshow will be Jock Glover, COO of Square Mile Investment Research and Consulting. In the following 2 weeks, we'll be back with our autumn multi-asset roadshow on the 13th, 14th, 15th, and 21st and 22nd of September, where we'll be visiting Harrogate, Knutsford, Birmingham, Bristol, and London. And you can hear the latest updates from the likes of Momentum, Morningstar Investment Management, Orbis, Pictet, and Vanguard. And our keynote for this roadshow is the ever-opinionated Managing Director of the Advisor Centre and old friend of professional advisor Peter Toogood. And to round off the month on the 28th of September, we'll resume our working lunch series, this time with Schroders, where Gillian Hepburn and multi-asset specialist Ben Papatlal will be joined by unique financial planning MD Philip Martin to discuss understanding the sustainability credentials of an advisor business and how this can relate to the path to net zero. All in all, that's a total of 9 hours CPD for you. So that is finally it for today's session. And all that remains is to once again thank Rosie for her presentation and answering all of our questions. But of course, our biggest thanks go to all of you, our readers, for your company with us this lunchtime. I trust you found the session helpful and worthwhile, and enjoy the remainder of the summer wherever you're traveling to or staying at home. And we'll look forward to seeing you again in September. Goodbye.